What's up, eggheads in training? I see you're holding on to that extra bit of income. Are you perhaps hoping to invest that money to make it grow? I can feel that maybe you're a little hesitant to put it out there. Can't think of where to invest it, or you're not yet familiar with the ropes of investing. Investing is a difficult thing to process and learn, especially for a beginner with little to no knowledge of finances, stocks, and the market. Well, buddy, I'm here to give you a little insight to how investing works. One thing you gotta know, a borrower is a slave to the lender. Your income is your most important wealth building tool. And when you're paying that away to somebody else, then it doesn't go to your personal finances for investing to move towards a wealthier future. Imagine this. Car payments now go up to about $500. But if you consider it for investments, like in a stable growth stock mutual fund, from your 30s to your 70s, it'll blossom into a hefty $5 million. I mean, wow, right? So, you must first climb yourself out of that debt hole to get your finances back on track and change your life. Maybe when you reach retirement, you can retire with dignity. You don't want to spend your time reading up on Investing 101 or how I could have changed my life when you're 70. But you really have to step up your game to get out of debt in order to free up your finances for investments. Now, in the financial industry, there's a lot of focus on only a part of the equation, just investing. And they all have their own plans and strategies and theories on how to maximize it. But it's so outstanding how many people in the industry, financial advisors, writers, bloggers, and all those other business-savvy people that have opinions about money, when in fact, they don't even have any. And their track record in helping people with investments? Well, it's as good as that month-old milk you still have sitting in your fridge. They only dabble with the top 3% of the public, and that's where they get all their money from. Wealthy people. A lot of these financial advisors won't even spend a single second on you. If you don't have the finances to get their attention, they won't even bother. And so, here at Egghead Finance, we've taken up the mantle to teach you and inform you about these things. So if you want to continue learning with us and grow your personal finances, why don't you click that like button, subscribe, and leave a comment down below. Maybe tell us, what has been your experience with investing as beginners? Alright, going back, what we've learned from these millionaires is that they recommend investing in good growth stock mutual funds and diversifying it across these 4 categories: growth and income, growth, aggressive growth, and international, and buy mutual funds with a commendable track record of at least 10 years. Well, you could say, why not just buy index funds? Yeah, that's true. You can if you want. Index funds like S&P 500 mirror the trends of the stock market, so if the market does well, your investments too. But it dips. Well, so do your investments. But the mutual funds that are great to invest in are those that outperform the S&P 500, and they're not that difficult to find and research. Check their performance, and you get 2 lines on the graph. One is the S&P 500, and the other is the mutual fund. If its line dips below that of S&P 500, then don't invest in that mutual fund. So as long as you have a decent portfolio of good performing mutual funds, you're bound to get some wins. Just make sure to put the money into the mutual funds. Make sure to actually invest. Data has shown that 74% of the drivers behind success in retirement is linked to your savings rate. It's the money that you put initially and continuously add throughout the years out of your paycheck. It's one of the big important reasons for getting wealthy in the long run. In relation to mutual funds, one of the bases in picking which one to invest in is the rate of return. Look at the ones with the longest track records of having great results. Pick something stable and trust it with your investments. It's a little precarious to invest in a highly risky mutual fund, and that risk could tip towards not making money. Another thing is to spread that investment across the types of mutual funds I told you about earlier. So there's growth and income, growth, aggressive growth, and international. A growth and income fund is sometimes called a blue chip fund, since it's the most expensive chip at the poker table, and this fund involves big companies. This is probably the least volatile, especially compared to the stock market. If you see the market trend going down, this will remain stable. However, even if the market does go up, it doesn't follow immediately. It moves more slowly than the market because it's less volatile and pretty stable. A growth fund, from its name, includes growing companies. The S&P 500 is a good example of this. The thing here is to find the right kind of growth fund. There are those that pretty much follow the stock market trends, and there are those that outperform even the S&P 500. Then there's the aggressive growth fund. These have small companies, a lot of startups. It's crazy, it's fun, and there are risks. Some of them might fail and go down to zero. It's much more volatile, so it could rise faster than the market, but then again, it can also fall faster. International funds have stocks only in overseas markets, not American companies. However, since international companies are often outperformed by American ones, this type of fund fares worse than the others we've previously talked about. If you want to include American companies, then consider investing in global funds, which include both international and American stocks. It adds a little spice by making sure you're not just betting it all on the American economy and you're diversifying your investments. Everybody talks about investing here and investing there and also a little bit over there, but it's just all talk. We need to actually start doing the investment, get some action in there. Millionaires didn't get lucky. They didn't have a perfect song with a happy ending. They didn't just hit the ball once and get a home run. It takes a lot of decisions and risks and learning. Don't invest in things you don't know about because that's how people get ripped off. It's your money, so imagine it as your own child. You have to keep a close eye on them, and you don't let other people take care of your child for you, right? So stop dreaming about that one lucky hit and begin planning and strategizing your finances. Go slow and steady with your investments, and that's the way to reach your financial growth. And that's a wrap. I hope we gave you a clear beginner's guide to investing. And if you found this video useful, please subscribe, click the like button, and hit that notification bell to get alerted about our upcoming videos so you can always stay informed. Catch you later, aspiring eggheads!